Hi, this is Ben Tafoya. I'm back with another episode of 5 o'clock Macro. It's Monday, April 27th, and today I just wanted to start a discussion of um, why economies contract. We have been talking up to now about some sort of basic concepts of macroeconomics, setting the stage for what I anticipate to be an intense discussion coming up regarding the current state of the economy. We know from the unemployment figures that there's substantial structural problems that are occurring right now. And starting this week, we'll get a indication of the uh, nature of the GDP contraction that we faced in the first 3 months of the year. Those numbers will be coming out on Wednesday morning at 8:30 a.m. Eastern Time, and it's a good setting this week for what I wanted to discuss, which is the ideas of what actually makes an economy contract. Typically, when we discuss macroeconomics, we talk about the business cycle, which is a concept that implies that economies at various times grow. They hit a peak, they contract, they hit a trough, then they resume the process of growth again. And so economists spend a lot of time thinking about, well, why can't we smooth out that process so that we have consistent growth? I mean, we've talked about the fact that there are models of economic growth that tell us that if we improve the factors of production that we have, that economies should grow. So why do they contract in this way? We talk about another model, which is the production possibilities frontier, that shows that this is the point that we can achieve in terms of maximum production given the full employment of our resources, both human resources, capital resources, etc. But sometimes things happen and economic activity slows down or economic activity contracts. And we talk about sort of two basic causes of recessions. One is what's known as a supply shock. So something happens and we see a shortage or a disappearance of a critical element in our economy or an element in our production processes. The classic examples of this occurred in the 1970s in the United States. In 1973, there was an oil embargo imposed by the oil-producing countries, largely the Arab countries, in response to the West's attitude towards the war in the Middle East in 1973. That caused shortages in oil throughout Western Europe and the United States. And we had a recessionary period during that time. We lived through a period in the 1970s with both inflation and unemployment or underemployment of resources, which was something at the time wasn't supposed to happen, but it did. And a large driver of that was the supply shock of the loss of oil. We went through that again in 1979 when OPEC, in a very short period of time, doubled oil prices and in the process restricted production, so that once again the oil-dependent economies in Western Europe and the United States were facing some structural difficulties, and we went through a period of very high inflation in the early 1980s because of significant increases in costs related to energy, oil, food, and certain other of what we refer to as necessities of life. So we get these kind of supply shocks periodically. In recent decades, that hasn't been a huge problem for the United States. It has for other kinds of economies. But the second big problem that we see with the business cycle is what we refer to as the demand shock. And this is when people stop consuming or investing, and it creates a hole in the economy. So we went through a demand shock as part of the reaction to the economic crisis from 2007, 2009, the collapse in the housing market. There was no demand for housing at anywhere near the level that we experienced during the bubble years preceding 2007. And in fact, we see that in a graphic like this. So this is GDP statistics from Fred from 2002 to 2012. You can see the shaded area here is the recessionary period, which started December of 2007 and went through June of 2009. And you'll notice this red line, which is investment, or I, from GDP. It dropped off earlier and steeper, and then you get consumption here dropping off as a result, and there's an overall impact on GDP, which then you'll see declines, and then it starts to turn up again. So this is subtle, but just because of the time frame that I'm depicting here, but significant depiction of this business cycle. So we're in an upward swing, and then the economy in 2008 stagnates out, drops a little bit. 2009, there's a significant drop, and then the economy starts to grow again. But one of the things that you'll notice here is that it takes a while, and in this last recession, it took 2 years for the economy just to get back to where it was before the recession, and it takes several years after that to get back onto the trend of what we refer to as potential GDP. How big can the economy be if we're fully employing all of our resources? It took a while to get back there, and just as we're getting back there, we have this particular crisis that we're going through now. The other reasons that economies contract would be enforced austerity. Government spending is a very important part of the modern economy. We went through the statistics last time showing how much of various economies GDP represents. But last decade, there was a crisis in the Eurozone, and that led to significant years of austerity, particularly in countries like Greece and Spain, which saw unemployment rates up to 20%, and that made for a very difficult recovery for those countries from the depth of that austerity. And that would be another very long and interesting discussion as to sort of why that happened and how it happened and who was really to blame. But it took a long time for those countries to recover, and Spain's a bit ahead of Greece in that recovery realm. Then there are other kinds of structural challenges that economies have. Latin America in the 1980s had a debt crisis, and Asia in the 90s had a currency crisis that related to debt. Both of these things are related to this fundamental structural issue, which is that many countries around the world borrow in order to fund capital investment in their countries. They borrow from outside their borders, and they have to borrow in US dollars, which means that to pay their lenders back, they have to generate U.S. dollars in order to do it. And when there's that crunch that sometimes happens, meaning that people are unable to generate dollars in order to pay folks back, then you have countries that are defaulting on debts or renegotiating their debt structure to force their lenders to take what's called a haircut, which means that they'll take back less money than they originally lent out in principal, but they're getting back at a very high rate of interest. So, Argentina's gone through that a couple of times. In the late 90s, Asia went through a crisis that was caused by the same kind of thing. They needed to come up with U.S. dollars to pay back debts. There was an impact on economies in places like Thailand, South Korea, Taiwan, etc. They recovered, but it causes significant problems. So, we can see from this left-hand column is the economic statistics from 2019, and we can see that the most significant part in the U.S. of gross domestic product are services. Services represent just about half of GDP in the United States. And you can see there the major categories of housing and utilities, healthcare, recreational services, food service and accommodations, and financial services and other services. These services are being significantly impacted today, and the idea is that right now we're facing both a supply and demand shock, meaning that people can't supply many of these services because their businesses are of necessity closed, and people can't buy these products because they can't leave their homes. They can't go to stores, even difficult to order many things online because priority is given to the necessities that people need to get, such as food and medical products and cleaning products. In this case, but we're in this period of economic crises again. But what makes this worse? Well, we've talked a bit about fiscal austerity, but particularly in a period like this, austerity is a huge problem because we have folks who are working for, say, state and local government or the federal government. If governmental jurisdictions cut their spending, it means other people will lose their jobs or lose significant portions of their income, which will make the problem worse. Debt is a problem during these kinds of deep crises because your indebtedness doesn't change. Wages and prices might fall as a result of a demand shock and supply shock like we're facing now, but debt doesn't change. And so the sort of self-reinforcing downward spiral occurs because people have falling wages, that higher degree of their income is dedicated to their indebtedness. For folks who can't sustain that, then they wind up defaulting, and that causes other kinds of weaknesses in their economy. So I'm going to take a short break right now, and I'll be back right at this spot.